In an unprecedented display of communication breakdown, White House Press Secretary Caroline Levitt's emergency briefing has left Wall Street and Main Street reeling. The 4-minute session, marked by contradictions and evasions, raised serious concerns about the administration's grip on critical issues. The briefing unraveled when Levitt stumbled over questions about the president's economic policies. When pressed about domestic automakers and price controls, she retreated to what one correspondent called a maze of non-answers. The situation worsened when addressing a national security breach involving classified military documents leaked on a messaging platform. Levitt's response, "The case is closed," left military families demanding answers about security protocols. Most damaging was her handling of economic questions. With the Atlanta Federal Reserve reporting a GDP contraction of negative 3.8%, down from positive 3.9% 2 months ago, Levitt's responses seemed disconnected from reality. The press secretary's performance hit bottom during discussions about a deportation case in Maryland. When confronted with facts contradicting court orders, Levitt deflected with unrelated crime statistics, leading to immediate fact-checking. Market reaction was severe. The Dow Jones Industrial Average suffered significant losses as investors processed the dysfunction at government levels. Trading was temporarily halted as circuit breakers activated. Former White House communications directors expressed alarm at the breakdown of crisis management protocols. "In my 30 years covering the White House, I've never seen anything like this," noted correspondent James Marshall. The aftermath has left many questioning the administration's ability to handle upcoming challenges, particularly as economic indicators flash warning signs. With consumer confidence shaky, this communications crisis comes at a critical time for the White House. In a dramatic market downturn, the Dow Jones plummeted by more than 720 points on March 14th, marking one of the steepest recent declines. The crash coincided with a White House press conference that turned into a communications disaster. The market collapse followed troubling financial reports showing high inflation, falling consumer confidence, and declining major indicators. The S&P lost over 113 points while the Nasdaq dropped 500 points, reflecting growing investor concerns. Fox News released a poll showing 56% of Americans disapproving of the government's economic management. Only 43% believed the White House was effectively fulfilling its duties. White House Press Secretary Caroline Levitt's outdoor press conference sparked controversy when questions arose about a potential third presidential term. Levitt's response was ambiguous. "The president was talking about this last night. He said it's not really something we're thinking about. The American people love what this president is doing." The press secretary's failure to rule out a third term triggered speculation about the administration's respect for constitutional limits. When asked about National Security Advisor Mike Waltz's status, Levitt gave vague assurances about team effectiveness. Markets had expected economic interventions like interest rate adjustments or relief packages. Instead, they received unclear policies, further weakening investor confidence. Canadian Prime Minister Mark Carney chose Europe over the United States for his first official visit, signaling potential shifts in North American alliances and trade relationships. The combination of market instability, constitutional questions, and changing international alliances points to deeper challenges facing the administration. As one analyst noted, when basic economic reassurance turns into a constitutional debate, you know we're in uncharted territory. The events left many questioning the White House's ability to handle future economic challenges, potentially affecting both markets and public confidence. In a bold diplomatic move that's making waves across North America, Canadian Prime Minister Carney has bypassed Washington, choosing to meet with French President Macron and British PM Starmer in Europe. This decision signals a dramatic shift in Canada's foreign policy, marking what experts call a strategic divorce from traditional U.S. dependence. Breaking news from Ottawa suggests that Canada is positioning itself as tomorrow's energy superpower, with ambitious plans to revolutionize its energy sector. Sources confirm that within 5 years, renewable energy could account for 30% of Canada's electricity production, attracting significant European investment. While the White House grapples with economic turbulence, Prime Minister Carney isn't just talking about energy. He's orchestrating a complete overhaul of Canada's defense partnerships. Canada is now exploring military equipment deals with Swedish suppliers, traditionally a U.S.-dominated sector. With the Dow Jones stumbling 3.5% in just 1 week, and the Biden administration imposing a 200% tariff on European wines, Canada's pivot toward Europe appears increasingly prescient. This comes as markets reel from the escalating US-EU trade war. Canada's message is clear. No more putting all eggs in one basket. Carney's administration is pursuing a multipolar strategy, strengthening ties with France, Germany, and the UK, while maintaining, but not depending on, US relations. The implications are far-reaching. We're looking at potential joint weapon development programs with European partners, new clean energy initiatives, and a restructuring of global supply chains. This isn't just about trade, it's about Canada positioning itself as a key player in a changing world order. As market volatility continues and global alignments shift, Canada's bold move might prove to be the blueprint for other nations looking to navigate the increasingly complex international landscape. The ramifications could reshape North American economic relations for decades to come. Here's a 1875 character news report based on the provided content. In a dramatic escalation of the US-EU trade war, markets are showing severe strain as a global Boycott USA movement gains unprecedented momentum. Financial experts warn this could be the catalyst for a major recession. The Biden administration's controversial 200% tariff on European wines and champagne, implemented as retaliation against the EU's 50% tariff on American whiskey, has backfired spectacularly. Critics point out a crucial flaw. The US doesn't produce champagne, making this move purely punitive while hurting American consumers. The market response was swift and severe. The Dow Jones plummeted 3.5% in just 1 week, while consumer prices surged as businesses struggled to absorb mounting costs. But the real shock came from the international response. Google Trends data reveals Boycott USA searches skyrocketing across Canada, France, Germany, and Italy. Canada, America's largest trading partner, is actively reducing U.S. imports. European and Canadian tourism to the United States has nosedived, with mass cancellations reported. The domestic impact is equally concerning. Major retailers including Walmart, McDonald's, Costco, Target, Foot Locker, Lowe's, and Macy's report alarming sales declines. Consumer spending has dropped 2.4% in the last quarter, forcing businesses to choose between raising prices or laying off workers. Adding to the economic turmoil, Trump media's SEC filings reveal $400 million in losses this year, with revenue barely reaching $4 million. This follows a pattern of business failures including Trump Taj Mahal, Trump Castle, and Trump Entertainment Resorts, all of which filed for bankruptcy. Economic analysts say this perfect storm of international boycotts, plummeting consumer confidence, and trade war fallout could trigger a severe downturn. The Biden administration faces mounting pressure to reverse course on its trade policies before the situation deteriorates further. With corporate America in panic mode and global markets reacting negatively, the question remains: will Washington act before it's too late to prevent an economic meltdown? Market turmoil and presidential promises collide as economy shows warning signs. In a stark contradiction to White House economic promises, the Dow Jones plunged 1,300 points while essential goods prices continue their upward spiral. Economic experts are challenging the administration's claims about manufacturing revival and tariff benefits. The reality on the ground simply doesn't match the rhetoric, says Dr. James Morrison, chief economist at Capital Market Analytics. The combination of aggressive tariff policies and trade wars has created a perfect storm of rising costs. In a surprising turn, President Trump's recent congressional address ventured into territorial ambitions, including a controversial bid for Greenland. "We need Greenland for national security. We're going to get it one way or another," Trump declared, prompting immediate rebuke from Danish officials who termed it completely absurd. Further raising tensions, Trump called for reclaiming control of the Panama Canal, despite Panama's sovereignty since 1999. The canal was built by Americans for Americans, Trump stated, drawing sharp criticism from Panamanian authorities. Adding to the complexity, Trump's administration canceled a major telecommunications contract with Verizon, redirecting it to Elon Musk's Starlink. This move contradicts Trump's stated mission to end rule by unelected bureaucrats. The automotive sector faces strain, with GM shares dropping 5% during Trump's address. Industry analysts warn that proposed 25% tariffs on Mexican and Canadian auto parts could increase vehicle prices by $4,000 to $10,000. No car is 100% made in USA, explains auto expert Tom Richardson. These tariffs affect every vehicle manufactured here. Electric vehicle production costs could surge between $3,500 and $12,000 per unit, according to the Anderson Economic Group, potentially derailing America's competitive edge in the EV market. In a devastating blow to American consumers and markets, President Trump's announcement of 25% auto tariffs has triggered what experts are calling a financial earthquake across the U.S. economy. The immediate impact could raise U.S.-made electric vehicle prices by $12,000, hitting American households already struggling with rising costs. The fallout was swift on Wall Street, where $4 trillion vanished from the stock market in a single trading session. The Dow Jones plummeted over 540 points, while the Nasdaq suffered a 4% decline. Industry giants took massive hits. Apple lost $160 billion in market value, dropping 6.3%, while Nvidia saw $180 billion evaporate with a 7.8% fall. Tesla emerged as the biggest casualty, with a 9.2% plunge wiping out $125 billion. Canada's response was notable, as Prime Minister Trudeau, speaking at the Ambassador Bridge, declared an end to the traditional economic security partnership. "We won't roll over," stated Doug Ford, Premier of Ontario, promising retaliatory measures that would make American people feel the pain. European Commission President Ursula von der Leyen condemned the move as a stupid blow to the global supply chain, while international markets reel from the policy's effects. The automotive industry now confronts a perfect storm of supply chain disruptions and consumer hesitation. Financial analysts are skeptical of the America First strategy's effectiveness, as evidence suggests these protectionist measures are backfiring. Rather than shielding the U.S. economy, the tariffs have sparked what many experts fear could become a recession. The market turbulence has extended beyond the automotive sector, affecting major tech companies like Microsoft, Meta, and Google. With investors pulling back and consumer confidence waning, the question remains: can the U.S. economy recover from this self-inflicted wound, or are we witnessing the beginning of a broader economic downturn? Market meltdown. U.S. economy faces historic $4 trillion wipeout as Canada pivots to Europe. In a devastating day for Wall Street, over $4 trillion in market value vanished, marking one of the largest single-day losses since 2020. The tech sector led the plunge, with losses between 5 to 7% triggering reactions across industries. The airline sector faced severe turbulence, with Delta Airlines announcing a 50% cut in profit forecasts due to rising fuel costs from Canadian tariffs. Delta's stock fell 14%, while American Airlines and United followed with drops of 11.2% and 9.8%. Major investment firms including BlackRock, Vanguard, and Citadel engaged in the fastest sell-off in 2 years, pulling $240 billion from the market in 24 hours. The banking sector wasn't spared, with J.P. Morgan Chase, Goldman Sachs, and Bank of America declining over 5%. Canada's strategic pivot toward Europe has raised concerns about America's global trade position. Europe, which previously relied on Russia for 40% of gas supplies, seeks stable energy partnerships. While the U.S. initially increased LNG exports, concerns about future policy shifts have pushed European leaders to look elsewhere. Canada's emergence as Europe's preferred energy partner threatens America's position. Unlike the U.S., Canada offers stability without the political volatility of recent American trade policies. The retail sector saw massive losses. Walmart lost 12% in value, erasing $56 billion, while Amazon fell 9% as consumer confidence waned. Cryptocurrency markets tumbled, with Bitcoin dropping to $42,000 and the broader crypto market losing $200 billion in 24 hours. The 10-year U.S. Treasury yields fall to 4.22%, signals investors fleeing to safer assets, a recession indicator. As America's economy appears to be fighting itself rather than global competitors, the question remains: what's next for a market in freefall? In a significant shift reshaping North American trade, Canada is emerging as Europe's key energy partner, backed by vast resources and reliable international relations. Unlike the U.S.'s volatile trade approach, Canada has maintained consistent policies, particularly through its CDA agreement with the EU since 2017. Trade between Canada and the EU has grown significantly, showing a 66% increase since CETA's implementation. Canadian exports to European markets have jumped by 46%, highlighting this partnership's success. This growth comes as Europe seeks dependable energy suppliers. For Canada, this shift means breaking free from U.S. trade dependency. Historically, 80% of Canadian exports went to the U.S. market, with 2023 seeing 90% of crude oil exports, $143 billion, flowing south. However, Trump's aggressive tariff policies forced Canada to rethink its strategy. The Canadian government's 2018 Export Diversification Initiative aims to boost non-U.S. trade by 50% by 2025. The LNG Canada project in British Columbia, starting in 2025, will process 1.8 billion cubic feet of natural gas daily, with potential to double capacity. The Trans Mountain Pipeline Expansion Project represents another step toward trade independence, tripling crude oil export capacity. This infrastructure enables Canada to redirect energy exports to European and Asian markets. These moves are transforming Canada from a U.S.-dependent partner into an independent global energy powerhouse. The combination of abundant resources, stable policies, and expanding infrastructure creates an ideal foundation for energy partnerships with Europe and Asia. As global energy markets evolve, Canada's approach to diversification positions it as a crucial player in international energy trade.